This is the inaugural, in some ways, inaugural episode of Tower Talk, Navigating Markets with Tarek and Mark. And that is the name of our new podcast slash YouTube channel for existing clients.
The inaugural.
Inaugural.
Look for this to be a long and outstanding and impactful. It will move markets. This little podcast.
First of many, and it's mighty.
Yeah.
of the podcast. Existing clients, you're listening to this or you're watching this, and you're like, I've been seeing you guys do this for a little while. You're absolutely right. We're just changing the format a bit and sort of the structure so that we can make it for a wider audience. So you've been getting this content already, but now this is kind of for everybody. So first thing though, I do want to say
the big difference here is we're going to try and do this monthly.
Yes, that's true.
We've been doing this talk quarterly. So now we're going to take up some other topics of interest. And of course, going there, we'll be happy to hear what topics any of our clients want to have us talk about. Sorry,
exactly.
Go back.
Yeah, we want to get your input on topics you want us to cover. We've got a couple on the docket already. Next month, we're looking at economic leading indicators, or economic indicators, I should say, the ones that we find interesting. I think that one we can have a lot of fun with. We're looking at what does risk mean? What does that mean to you? What does that mean to me? Charitable giving, day trading, does it work? Does it not work? Political factors, a lot of stuff. So please send us your ideas. We'd be happy to hear from you. And that's what the podcast is going to look like. Tower Talk, Navigating Markets. All right, let's jump in, Mark. Why don't we start with...
Watch for it.
Yeah. Every month it'll be coming out. So, but yeah, why don't we start with going over returns for the last quarter or year to date for the strategies here at Tower?
Sure. Well, why don't I take that since I want to brag about Canadian momentum? So I'll hold back on momentum to say our enhanced index. Remember, we've got four portfolios in the enhanced indexes. They are global indexes. They're well diversified. And one of the reasons that I'm going to be giving you some numbers that are not as stellar in our enhanced indexes is because they are so diversified. They've got a fixed income component, they've got US component, they've got a Canadian component, and they've got European component, as well as some emerging markets. And there's some really cool little indexes in there like water and agriculture. Mm-hmm. But this is what I would call ballast. This is what I would call stability, diversification. I would call it good, solid liquidity. The returns range from 2.8 to 2.4 to 2.0 to 1.4% year to date through June 30th.
And I'll put the returns up.
Strategies from good.
So if you're
Excellent.
watching,
please
you can see the returns. Yeah.
Yeah. So the best return was in the aggressive growth, and the next was growth, and so on down through to conservative. And all they are is a different mix of all the different portfolios. And the conservative has the most fixed income. Now, that is going to change, I think, in the next little while, because looking ahead, fixed income rates are higher. At least they're going to become, we think, more stable, if not start turning down a little bit in the next couple of years. And that means that the bond portfolios will begin contributing to returns as opposed to lagging or costing returns. Now, the one that I wanted to get to right away, but Tarek made me feel like I had to be honest about our bad returns first. And 2.8 to 1.4 isn't necessarily bad, but
it isn't. And if we look longer term, they are. Yeah, let's get there. Okay, never mind. Yeah, let's go to Canadian momentum.
Good, do that. What's longer term? Yeah.
Okay, let's look longer term. Then we'll go to Canadian momentum.
No.
So aggressive growth. If we look 1 year, 12 months, ending June 30th from last June in 2022, we're at 7. 3 year, we're at 12.2, right?
That's per year.
Yes, that's annualized, right? So 12.2 compounded over the 3 year period. If we go to growth, it's 6.1 for the year, 7.9 for 3, and so on and so forth down the list. We've been counseling our clients, as you mentioned, not to limit their fixed income. So we don't actually have a ton of clients in the ones below that, except for specific situations. So I won't even quote those. But similar idea where, you look at the 3 and you look at the 5 and the returns are better. So just want to emphasize, we're recognizing that this first half of the year was not, it's not ideal, but if we look at a longer term basis, we're right up there and we're happy. So, but yeah, you were going to say something about Canadian momentum.
This is the time where, we'll quote our compliance officer, where we have to say somewhere in the midst of a podcast, historical returns are not necessarily a reflection of the future returns. We really want you to remember that.
Yes.
Because this 6 months is not one that we want to brag about.
That's right.
That may not be the same picture as the future. It will likely be better. Anyway.
Yes.
But I'm not promising that. I need to recognize John Smeaton. He's going to beat me up if I say that. Anything other than that. Now, Canadian momentum. The sample account that we use for this one it's tracks virtually the same on every account that's in Canadian momentum, but it is Elaine's account. Has an 11.9% return in the first 6 months, year to date. Not annualized, meaning that's a pure return. If you annualize it, you would say, well, that's 22 or 24% return. No, we're not doing that. It's 11.9 clean, pure return year to date in her account. That's the Canadian momentum. The Canadian momentum continues to be an absolute star. We've got our screens. We run them with discipline. We make the changes. You might say with heartless abandon. When we get our 12 new names, we move right into those 12 new names, and it has worked brilliantly. So, if you don't have momentum in your portfolio with us, we really would like you to. And if you have both, if you only got momentum, then we kind of like to encourage you to have some value, because it's better. These two portfolios they will work at odds with each other. They will complement each other nicely, and it would be better if you have a little bit of both, because there may come a time when our momentum doesn't perform as well as it is right now, and at that time, likely it'll be the enhanced index that's the one that we're bragging about, and we'll still tell you the truth about our momentum when it's not performing. But right now, stink. That thing is amazing, and the longer term numbers, I'm sure Tarek has them. Are just as amazing. Do you have them? What are the 1, 3, and 5 year numbers?
So 1 year, we're at 10.4 year over year, June 30th. 3 years, 17, and it's, as you mentioned, annually, right? 17% annually on a 3 year, and then 5 year at 9.3, right? And so we should also mention with the momentum, everybody who's in it knows this, but we're openly trying to beat the TSX. And for the same time period, this first half of the year, TSX only did 5.7% on a total return basis. So we're double year to date. So
okay, let's go to markets, because we're at about eight minutes here, Tarek.
Okay, let's do it.
Talk about markets. You've done some interesting work comparing the S&P with Canada, and I'm going to give you the conclusion here, and then you can go wherever you want with it. But Tarek dug into some numbers, and basically he identified that there are 7 large companies, Alpha, Facebook, some of these others, Apple, and so on. The 7 represent 30% of the market cap of the S&P 500. Those 7 companies are the ones. Yeah, those 7 companies represent the vast majority of the return in the U.S. Tarek did some sort of spreadsheet work to back out their numbers and see what would the rest of the S&P 500 have done. It would have had a return very similar, if not a little bit lower, than the Canadian market. I think that's really interesting work. In other words, we have had a market both in Canada and the US that has been very concentrated on these tech companies, and the rest of the market has yet to get going. Will it? Oh my goodness, I'm sure it will. It looks like inflation is being shut down. Take over, Tarek. What am I talking about?
Absolutely. So it's really interesting. So the S&P 500, this is the US's biggest, or I should say most widely quoted index. It's up nearly 17% year to date. The US market is just in full bear market, full bull market territory. But as you mentioned, when you pull these 7 names out, the usual suspects, Apple, Amazon, Netflix, or not Netflix, actually, Nvidia, markets are basically, you could call them flat. So this is not a broad rally. This is a rally in a few names that happen to be the biggest companies in the United States and in the world, that are really carrying along the rest of the market, which is interesting. Now, what that means is, we if we're going to move on to inflation and interest rates. I'm always talking about inflation and interest rates. Inflation is finally starting to come down. We're down at 3 and 3.4 in Canada, or in the US and Canada respectively, which is huge to be down close to there. Rates are likely going to stabilize, maybe 1 or 2 more. And so that sort of stability in the interest rates and that sort of confidence that companies and markets can have that, okay, we're not like going to be jumping up 3 rate increases in the next 6 months or something, means that we're going to start to see, in this one analyst's opinion, we're going to start to see some of these other companies that aren't seeing these returns start to demonstrate their performance. That's my reading of the situation.
The other work that Tarek did, we were talking about it earlier. The other work that Tarek did was on the cost of the hike in rates. For sure, the higher rates will flow through to higher mortgage payments for people who are on variable rates. Number 2, that will reduce discretionary spending. Number 3, that will put a damper on the growth, the recovery. So we should be planning that into the forecast for the next few years.
Right.
But the truth is, wages are going up. There are other factors that are at work. The one that I'm always watching is human ingenuity. People continue to improve their companies. They continue to get rid of deadwood. They continue to improve on their technologies. And therefore, companies come out of it looking better as a result of tough times. So, I'm I'm also an equity guy. Those are my disclaimers, but the equity markets have proven to be great places to be, and I think it still is. Okay, and one more thing.
Okay.
If you happen to have a friend that you think would be interested in what we're doing, we're looking for more clients. We'd love to look after some of your friends. So let them know, show them the video, see if they want to join us as well.
Yes, we want to keep this video, tight, short, to the point. So if you watch this video, you enjoyed what we had to say, you want to hear what we have to say next time, please like, subscribe, follow, depending on the medium you're listening to us with, because we'd love to make sure that you can hear when the new episodes are dropping. And as always, reach out. Contact info is in the description. Send us an email, send us a text, send us a call, whatever works. And we would love to hear from you. Until next time.